Today on InvestTalk, we talked about how credit card debt may be becoming a problem for millions of Americans, answered questions on SMCI, TXT, and Foot Locker, and ended the day talking about a potential crisis brewing at U.S. ports.
This is InvestTalk, independent thinking, shared success.
Let's dig right into our main focus point today, which is about how much credit card debt is too much. So why are we talking about this? Well, according to the Federal Reserve, Americans collectively owe $1.14 trillion in credit card debt as of the end of the second quarter of 2024. That's up 5.8% from last year and $27 billion increase from just the last quarter. So what's driving this rise? Well, in short, kind of inflation. Over the past few years, many people have been relying on their credit cards just to cover day-to-day expenses. As a result, we're seeing a surge in delinquency rates, and defaults have jumped 2 percentage points higher than they were pre-pandemic in 2019. But the real kicker of what's hurting people is that as we're trying to tame inflation, as things become more expensive, what did the Fed do? They raised rates. So interest rates are now through the roof compared to where they used to be. They've climbed from around 16% during the pandemic to about 24% today. So then the question becomes, how do you know if your credit card debt is spiraling out of control? Well, first, you should ask yourself, is your debt affecting your overall financial health? How do you know if it is? Well, is it stopping you from saving for your goals? If paying off the debt means that you can't save for an emergency fund, save for retirement, any number of things, well, then certainly it could be a problem. Secondly, are you only making the minimum payments on your cards? If this is the case, you could be paying for decades. If you're only covering the minimum, you could be stuck paying off your debt for far longer than you expect. How does the math work out on that? A $5,000 balance at 22% interest with minimum payments could take 281 months to pay off. 281 months. And how much of those payments, the aggregate payments, will be interest, an additional $8,500 on $5,000 balance. So certainly, if you can only make the minimums on all your cards, that is a major red flag. Another number which credit agencies use, and you should pay attention to as well, is credit utilization. If you're using more than 30% of your available credit, and that doesn't mean more than 30% on any individual card, but 30% on your total credit line. If you have 3 credit cards and the total credit you have combined with all of them is $100,000, well, if you're using more than $30,000, then you're using more than 30%. And if that's the case, you're using more than 30%, it's likely hurting your credit score, which can make it more expensive to take out bigger loans down the road. So if any of these things apply, if all of these things apply to you, what can you do if you're drowning in credit card debt? Well, the first and the most important thing to do is cut unnecessary spending, especially if your charges are more about wants rather than needs. If you don't attack the problem head on, you certainly cannot beat it long term. Now, once you've done that, once you've realized what the issue is here, if you can, consolidating your debt with a lower interest loan might be a smart option. And if you're truly struggling, there are debt relief options, there are negotiation options with the company to which you owe money. But be wary of false promises, because a lot of people who find themselves in situations where they have massive amounts of credit card debt, financial issues can cause desperation. And what happens when you're in desperation? You're trying to solve problems, you're trying to better your life. That's when people come in and they can offer you these false promises. People can come in and try and scam you. There are a lot of companies out there, a lot of people out there that see people in desperation and offer solutions, in air quotes, for those of you who don't watch our YouTube videos. And so this is particularly a time where you would want to be very wary if you get people reaching out over the telephone, you get offers in the mail. Just be careful for those who may be trying to take advantage of you. So, at the end of the day, I think the best approach is to stay aware. You have to understand what your financial situation is. You have to understand what the limitations are within your financial life. You have to understand what your long-term goals are and what is stopping you from achieving them. And if you find yourself in a situation where credit card debt is a big issue, create a plan. Pay down your debt. There are many different strategies for paying down your debt. And as interest rates are falling, now may be a better time than it has been over the past 2 years to look at some of those options, to look at consolidating your debt in a singular loan, to look at any number of options that can help you pay down more quickly. But most importantly, more than anything, attack the root cause and make sure you don't fall back into the same traps. Let's talk a little bit about the market today. US stocks were mostly lower. The Dow finished down 70 basis points. The S&P 500 down about 20 basis points. The NASDAQ up about 4 basis points. And the Russell 2000, it looks like, finished down about 1.19%. Today's weaker performance really followed a higher finish on Tuesday that saw the S&P post its 41st all-time high of the year, 41 all-time highs. Laggards on the day included home builders, energy, biotech, media, railways, chemicals. Big tech was mixed, though the group held up by Meta and Nvidia. Outperformers included large cap semis, airlines, utilities have been performing really well this year. Insurance, A&D, casinos, and auto retailers. Treasury is a little bit weaker with the curve steepening once again. The dollar index up 0.5% with notable strength on the yen cross, and gold finishing up 30 basis points. Crude oil ended off at 2.6% below $70 a barrel and more than erasing Tuesday's gains. Overall, nothing really new as today's market continues to wait for the start of Q3 earnings. Easiest excuse for today's pullback, probably some combination of overbought conditions following the big push higher over the last couple weeks, a recent batch of softer data, and some skepticism from many, including myself, about China's stimulus and the continued ramp up in geopolitical tensions. More talk recently about how valuations remain challenging. The S&P is well over analysts' year-end 24 price targets, along with the dampened buyback support into earnings, and of course, the big item coming up in the next 2 months, election uncertainty. Now, the economic calendar was fairly quiet today. August new home sales declined less than expected month over month. July was revised higher, though. Things start to get busier tomorrow with initial claims, durable good orders, and the final release of the Q2 GDP figures. Tomorrow also brings a barrage of Fed speak. Also a reminder that core PC inflation hits on Friday, though the Fed is more focused on growth risks now. As we know, they mentioned in their most recent press conference, Powell did, that they're fully shifting from being worried about inflation and the labor market, though that doesn't mean that your focus can't shift once again if numbers surprise to the upside.
Thank you for your show. I have a question regarding a company called Dextron, Dextron. I believe they're a Saudi Arabia company, and I wanted to know what you think about that as a possible problem and what their future outlook would be. Appreciate your help. Thank you.
So ticker TXT, Textron, it's a U.S. company. It's headquartered in Rhode Island. It is a aerospace and defense company, something that, given recent tensions in the Middle East, in Eastern Europe, some of these companies have done particularly well this year. Unfortunately for Textron, they are not really one of them. They're underperforming their industry by about 7%, 7.2% in 2024. So let's take a look at their fundamentals. Well, in terms of their balance sheet, it's not too bad. They had about $4 billion of debt in 2019. That's been whittled down to $3.963 billion this year as of this most recent quarter. Now, that's not a lot of progress, but they're not adding more debt to their balance sheet. And for a $16 billion market cap company, that's fine. Now, they've been buying back shares, something that we do like over the past 5 years. In 2020, they had just over 230 million shares outstanding. Now it stands at about 187, it looks like. They don't pay much of a dividend. It's like 10 to 20 basis points on average over the past 5 years. And the dividends per share has been locked at 8 cents per share. But keep in mind, we're buying back shares over the past 5 years. So it's actually less being paid out to investors in aggregate. Now, their margins are fine. They're stable, about 8.7% back in 2018, projected to be 7.8% this year. Their cash flow, it's stable. Their profitability, like I said, is pretty stable. So for me, the explanation on why, even though in a year where there are some themes that would power these aerospace defense companies higher, why are they underperforming? Well, not a lot of growth. The revenue is about exactly where it was in nominal terms, not even adjusting for inflation, exactly where it was about 5 years ago. And so this is a story of a company that sure may fit a good theme. It may be reasonably priced, trading at 2 times its book value, trading at 12 times its forward-looking earnings, but it's not a lot of growth. So I like where your thinking is. I like the theme that you're thinking about, but I would still look elsewhere. Thanks for the call. Let's head over to our InvestTalk YouTube channel question bank and answer a question that came in there from Jim Leahy. And that's because when commenters and viewers like Jim go over and ask us a question in the comments section of any of our videos, we like to get to them as soon as we can. And this question is, do you think EQIX is a good stock to buy and hold? So let's take a look at EQIX, which is EQIX Inc. It's a digital infrastructure company, provides a platform for foundational cyber infrastructure, data center services, interconnected services, and overall support services. It looks like it has a pretty spread out business geographically. The United States actually only accounts for 38% of its revenue, 6% from other countries in the Americas. EMEA is about 25% of its revenue, and the rest is coming from a spattering of other countries. Now, over the past year, it looks like returned about 21%. That's pretty solid, pretty in line with the industry overall for this year. Year to date, it's up 10.5% over 3 months, up 20%. And what's really powering that? Well, some pretty strong growth and the prevalence of data centers within the narrative of the secular theme that is artificial intelligence. Now, over the past 5 years, their growth was about 10% on an annualized basis, though not as good, it looks like, over the past year. Or rather, it's not projected to be as good coming into the end of fiscal year 2024. Now, in terms of debt, they have $17 billion of debt on an $84 billion market cap company. They've issued some shares over the past 5 years, started in 2020 at about 85 million, now about 95 million. So percentage-wise, a substantial amount of shares. Now, cash flow is improving. Earnings have been consistently upgraded. It looks like their leverage is decreasing as their cash flow is improving. Their interest coverage ratio went from 3.1 at the end of last year to about 3.26 in the most recent quarter. And they pay a 1.92% dividend. They've been a dividend payer all of the past 5 years, and it looks like that has grown pretty consistently from $9.12 per share, projected to be $17.16 per share. Let's take a look at their profitability. Improving 7.2 in their net margin 5 years ago, 12.4 projected to be this year. All of this sounds great, but what does this price look like? Well, their forward-looking price to earnings is 73 times, which is still below their 5-year average of 84 times. May not be the best metric to look at. Let's look at their price to sales. 10 times on price to sales. That's pretty expensive. 25 times on price to cash flow. Almost 7 times on price to book. It looks to me like it's a little bit overbought right now. You take a look at their price chart. It's been marching up since May, from 700 to about 900. This looks like it's probably set for a technical reversal at some point. It looks a little overvalued to me, but I do like the growth picture. I do like what the balance sheet looks like. I do like the earnings upgrades. Overall, I like the company. I would keep it on my watch list. It looks like it's had quite the run since May and is ripe for a little bit of consolidation. Let's keep it moving and pivot to the InvestTalk Voice Bank for a question that came in earlier.
Hi, guys. This is Brian from Ocala, Florida. Can you please take a look at Ryder Corporation, ticker symbol R? I'm looking for a mid-cap industrial. Thank you. Bye.
So Ryder Systems, ticker R, is a mid-cap name, certainly. It's about a $6.67 billion market cap. They have $8 billion in debt, so they got a little more debt than I would typically like for a company of this size. Now, their cash flow has been pretty steady at a significant clip. Their profitability has been improving. They didn't make any money in 2019 and 2020. Now their net margin's about 4.2%. Do they pay a dividend? They do pay a dividend. And they paid a dividend all of the past 5 years, though that dividend yield has been decreasing as the price has been appreciating. Over the 52-week period, up 42%, up almost 30% year to date. And why is that? Well, a lot of that is due to kind of a shift towards a long-term leasing model. Ryder Systems is a logistic and transportation company, and that has kind of de-risked some of the demand issues from how the business was previously run. So despite kind of a weaker used vehicle pricing, they can still generate sales. They can still generate positive earnings. And like I said, they've certainly improved over the past 4 years. Now it's price to book. It looks like it trades at about 2 times price to book, 11 times forward-looking earnings. I think this is a company that is on the right direction. I think it's one that has pretty significant growth, especially given what area it's in, what industry group it is in. It's probably a little overbought right now if you're taking a look at the chart. I mean, it's had a run up since about October, pretty steady, some pullbacks, but overall, I would, again, like the last name, I'd probably keep this on my watch list, though I don't think right now is the perfect time to buy.
Here's a quick reminder. The newest InvestTalk Wealth webinar is happening soon, Tuesday, October 8th at 11 a.m. Pacific Time. The InvestTalk Wealth webinar will focus on effective strategies for managing your 401k and enhancing your retirement savings. Go to investtalk.com and sign up for our upcoming Wealth webinar, October 8th. It's free to attend, but you must pre-register. And please tell your friends.
Gentlemen, my name is Sam. I'm calling from West LA. I love the program and I love listening to it. 2 stocks I have my eye on: Poet, P-O-E-T, and Palantir, P-L-T-R. Wanted to know your thoughts. I am holding both, and both up pretty good. So I'm just curious to know if I should unload or buy more or hold on to them. Thank you so much. Take care. Bye.
So in order to try and get to everyone's question, we'll tackle one of these. We'll tackle the first one, that is Poet Technologies, ticker POET. And Poet is a semiconductor company. What they're trying to do, given that they are a company in the growing stage, not growth stage, but growing stage, even before the growth stage, is they're trying to create a singular microchip that can essentially put together a bunch of different parts of the semiconductor process under one hood. And so doing that would really go a long way in terms of scalability, not just for AI, but for a lot of their customers. It would really help with cost efficiency. It would help with power needs, have more higher performance because it's one integrated system. All of these things which sound pretty fantastic. And so, this combined optical interposer chip is something that has drawn the interest from some partners, including Mitsubishi Electric. So they want to integrate this system into their cars. And that has caused the stock to pop a little bit, even though they're not in a great cash position. Their cash flow is falling, and it's in the negative and falling. Their profitability is falling in the negative and falling as well. They've never made money. They're not going to make any money on the horizon. They're a serial issue of shares. So the big problem for me here is ownership dilution. Now, you look at that year-to-date return of 400%, you're saying to yourself, that is crazy, and it is crazy, but pull that back to a year, it's up 40%. It fell off pretty precipitously towards the end of last year. In about end of October, early November, it was flat at about $1.20, ranging from $1 to $1.20 until April. And then it had a spike, a fall-off spike. We are where we are now at about $4 per share US, $6 and 23 cents in Canadian dollars. So I would say, depending on when you bought it, I would probably start to trim this name. Why? You know that we here don't generally like companies that don't make money, though it is true that those are the companies that, should they be successful, are the ones that are going to give the highest returns. But it's a risk return question here for me. And for me, I see a company that, although they are improving on their stock price, the most worrying sign is that there's a lot of dilution going on and they're not in a good cash position and they're not improving their cash position. So I would probably sell. It doesn't mean it's not going to go up. It could certainly go up. A lot of this is based on the expectation of what it's going to make probably 5 years from now. But I just think for me, they're not in a great cash position. They're diluting the heck out of shareholders. So if you're up a lot, I would at least start to trim and take some profits. Thanks for the call. Let's do 2 in a row, but instead dip down into our InvestTalk. So I'll tell you why I got distracted for a second. Our InvestTalk podcast review questions from iTunes. And it's because this one comes from user Beefy Beef. And the question is about ticker OMCL. So as we look that up and also hopefully all laugh together at how funny that name is, ticker OMCL is OmniCell. And OmniCell is a healthcare tech company. What they do is they create systems for pharmacies to track medications. And so it deals with one of, I would say, the largest issues within the healthcare system, which is communication. I've always said that one of the biggest problems within the healthcare system is that you go to one hospital, you go to a different hospital across the country. Transferring medical records has never really been a perfect science. It's never been an easy thing to do. And so what these guys are trying to do, and what these guys do, is they create systems for pharmacies and healthcare companies and hospitals to communicate with each other. Now, over the past 5 years, they've seen some pretty decent growth, up 7.8% on an annualized basis. Its market cap, $1.974 billion, about $615 million of debt, which is not too much debt. Their interest coverage ratio is about 2.84 times. You don't remember what that means? That means the amount of earnings before interest and taxes that pays off the interest. So how can they service their debt before paying off interest and taxes? Now, their cash flow, it's kind of been stagnant over the past 3 years. And one thing that, again, I don't like is they've been issuing a lot of shares, almost 10% of shares outstanding issued in the past 5 years. The market is shorting them to the tune of about 5% short interest right now. Now, year to date, they're up 13% over 3 months. They're up 59%. And in spite of all of that, over the past 52 weeks, down 12%. Again, this is another company that seems to me like a serial issuer of shares. Their cash flow is pretty stable, though their profitability has fallen as well. That's something to note. They didn't make any money last year. They are projected to make money this year. It could just be a certain what's the word I'm looking for? Non-recurring items that could drive book profitability negative. Still, I don't like companies within the healthcare tech space that like to issue a lot of shares. And so when the market has a decent amount of short interest out there and the price and the stock is showing some weakness overall over the past year, I would tend to believe the market. Thanks for the comment. Looks like we got a live call. I love live calls. Let's go to Sammy in San Francisco, who has a question about PayPal. Do you own it or are you looking to buy it?
I do not own it. I wanted to ask you for a good entry point.
Sure. Let's take a look at PayPal. PayPal, something that I use, I think a lot of people use, and it is a payment processing company. It's a technology platform. I think it grew out of its spinoff from eBay. My mom used to sell plates and Limoges porcelain on eBay. So PayPal has been a big part of my life for quite some time. They own Venmo. That's also a big part of my life and a lot of people's lives. And so what you see over the past 5 years is, well, it had a lot of strength heading into the pandemic, and then it started to taper off, and it started to pick up a little bit again over the past year, up 31%, up 25% year to date. I think overall, I like this company. You know, within payment processing, within generally trying to pay for services online, PayPal is the strongest name. Now, they have some debt, about 12, 13 billion, and that's been increasing. That's something that I don't like. Since 2019, their debt's increased from 5.4 billion to about 13 billion this year. So it's heading in the wrong direction. But even with that, I mean, their interest coverage ratio, it's about 15 times. So they're not overly levered. And in the past 3 years, they've bought back shares. Now, they don't pay a dividend, but this is one of those names where you may be picking it up at a point where you can see some growth that you haven't really seen in this name if you were a purchaser back in 2021 or 2022. And so with all this in mind, with the solid growth they've had over the past 5 years, 13.4% or 13.9%, they're trading at about 16 times their forward-looking earnings. Their average over the past 5 years is about 28 to 30 times. Price to book, about 3.9 times. Price to sales, 2.6 relative to their 5-year average of 7. It's a name we've been looking at. I kind of like where the price is now. Overall, the balance sheet looks fine. There's not a lot of short interest out there. It's trading at a pretty decent price as well. So I actually like where it is now, if I'm being honest. Thanks for the call. Looks like we got another live call, this time from the opposite coast, from Brooklyn, New York. Looks like you got a question about FL. You own it or are you looking to buy it?
Right.
I'm looking to buy it. It looks pretty attractive at the price right now. And I was thinking, is this a good time to jump in and buy it?
Yeah, let's take a look. So Foot Locker is a retail athletic shoe company. I used to be into sneakers, so I certainly spent a lot of time in my youth in Foot Locker. They wear the basketball referee outfits in there. But anyway, that's besides the point. Now, I think that there's a lot of retail names that I do like. We've talked about some of them. People have called in about some of them. But I think that when it comes to retail names like Foot Locker that don't really have much in the way of production and are mostly just distribution, I don't like them as much. And the market looks to agree with me here. It's up, or it has 11% short interest. That is a lot of short interest. Their growth over the past 5 years has been flat. Their revenue's fallen over the past 3 years, consistently fallen over the past 3 years. They didn't make any money last year. They are projected to make $1.60 this year, but they have $2.9 billion in debt on a $2.6 billion market cap company. They are highly, highly levered at this point. They don't have that much cash on hand, and cash flow is just starting to pick up for the first time in 3 years. I think this probably has some more way to fall. It's still trading at 14 times its forward-looking earnings. Usually it's around 9 to 11 times. So I do like your thoughts about some of these retail names that haven't done particularly well, specifically within clothing, apparel, and such. But I think this one is one of those names that maybe is not the right time to get in. I think it probably still will struggle from here. Thanks for the call.
Okay, thank you. I appreciate it.
Thank you for calling. Love talking to you guys. Now, after answering a bunch of questions, let's hear me talk, I guess, for a little bit. And I want to talk about something that maybe you haven't thought about for quite some time. And that's something that's making quite a comeback on Wall Street. Bonds. For years, bonds were seen as the safe and steady investment, but it's been tough. 2022 was tough. And with interest rates rising, they've been anything but steady. Now, with interest rates starting to fall, investors are and should be thinking about starting to turn back to bonds because you can see some real gains here. So why bonds now? Well, I mentioned it. Interest rates are falling. And when interest rates fall, the value of existing bonds generally rise. Why is that? Well, older bonds with higher interest payments suddenly look pretty good compared to the newer ones that are being issued with lower rates. For a while now, many investors have been sitting on the sidelines with cash in money market funds. How much cash? Over $6 trillion. And while money market funds were great during the rate hikes, the falling rates are making bonds a better option for those looking to lock in higher yields. Treasuries have dropped by about 1% already, but investors can still get close to 3.5% return from treasuries. Long-term treasuries. Now, when it comes to buying bonds, it's not one size fits all, and that's because there's many ways to go about it, and we've talked about some of those ways on the show before, but let's recap them for all you guys out there right now. And first, you have to think about what kinds of bonds you're going to buy, right? There's lots of choices. There's corporate bonds, there's treasuries, there's municipal bonds, and each of them have their benefits. Each of them have their risks. Some have more credit risk. Some have more, duration risk, depending on the maturity there. And there's another question, which is, should you buy individual bonds or should you buy bond funds? Now, when you buy individual bonds, it guarantees you'll get back the principal that you put in, no matter what happens to interest rates in the meantime. Now, obviously, the guarantee is only if the issuer itself doesn't default. There is certainly still credit risk there of buying individual bonds, but should the bond be, or should the issuer not default, then at maturity, you get back your principal payment when you own an individual bond. And that sounds good, but what if you want more flexibility? Because buying off-the-run bonds, which are bonds that were issued a while ago, rather than the on-the-run bonds, which are new bonds, selling off-the-run bonds can lead to haircuts because liquidity is not as good. Bonds are a high-touch market, meaning that it's more person-to-person communication from a broker perspective. So if you want more flexibility, bond funds are another option. These funds hold hundreds or even thousands of bonds. What that does is that spreads out risk, credit risk, that issuer risk. And unlike individual bonds, you can sell shares in bond funds whenever you want. It's easy. Bond ETFs. Super easy to go on and sell. Very liquid, depending on which ETF it is. And so this makes it easier to get cash out if you need the cash. But it's important to note they lack that one simple benefit of individual bonds, the certainty of holding to maturity, adjusting for the risk of default, that you get your principal back. With a fund, you can capture gains or suffer losses depending on how the market moves. But with individual bonds, you're locking it in. If you buy a 6% bond, if you buy a 3% coupon bond, 5 years, and the issuer doesn't default, interest rates move, doesn't matter. You are getting 3% on that coupon, and you are getting your principal back when the bond matures. Now, if it's owned by a bond fund, well, now that bond fund's net asset value, how much that fund is worth on a per share basis, is going to change depending on the value of the bonds that it owns. And so you can see the difference here and why some people may want to own bonds, some may want to own funds. So whether you're looking for steady income or planning for the long term, it's obvious that as we shift gears from a cycle of hiking to a cycle of cutting, bonds are very much back on the table. So now might be the time to consider if bonds or bond funds, depending on what your specific goals, what your specific financial needs, what your constraints, what your requirements are, bonds, or maybe even bond funds, might be the right move for your portfolio. Let's go to Nick in Hayward, who has a question about SMCI. Do you own it, or are you looking to buy it?
I'm thinking about buying, but I'd like to know where you think it might be a pretty good price. And I want to thank you for your wonderful show. Thank you very much.
Well, thanks for calling in. This is, as I say all the time, this is honestly my favorite part of the day. But let's dig into this. SMCI, Super Microcomputer Inc., had quite the run up at some point over the past 18 months. And the reason why it did well was, there was a lot of hype around AI. They started working on their servers, which were more energy efficient for running these models, probably a lot earlier than a lot of other companies did. And because of that, they saw their price appreciate a lot. Now, they at one point were above $1,000. Now they're trading at $4.58. And one of the reasons for the most recent drop off, and something that is still evidenced within the fact that they have about 17% short interest, was a research paper from Hindenburg Research, an accusation that they had been manipulating accounting. And so that was about a month ago. I'm not sure if anything had come of that, though I'm not seeing offhand kind of a resolution there. And, Hindenburg makes their money from shorting a stock, shorting a stock for which they found a reason why the price is overvalued. So there's some misaligned incentives there. But regardless, I don't think that a company is going to come out without any evidence at all and put in a position and make an allegation like this. So because I haven't seen anything come out of this, frankly, I would stay away. They have found some companies that have had some dodgy practices in the past. And it's also important to note that, again, I think when the market is giving you something like 17% short interest out there, that's the market telling you that they believe the price is overvalued. Now, that can lead to positive outcomes for the longs because that can lead to squeezes. But I just think with everything out there about this company, not any resolution that I've seen so far from this report, I would stay away for now until at least you get some resolution there.
Okay, good. Look, thank you so much for your information.
Yeah, thanks for the call. Before we head off for the day, I wanted to dive into what is kind of a developing situation in the Gulf, and that is that there is a looming strike at key East and Gulf Coast ports. Companies are scrambling, and the October 1st deadline has them making bold moves to avoid getting caught in the chaos. U.S. businesses that rely on these seaports have started importing goods early, rerouting shipments to the West Coast, even paying, probably praying too, for expensive air freight to stay ahead of a potential work stoppage. Now, the center of this is the stalled contract renewal between the International Longshoremen's Association, which represents 45,000 port workers, and the U.S. Maritime Alliance. Pay disputes have left negotiations at an impasse, and if the strike hits, it could disrupt supply chains across the country. Retailers, manufacturers, And other importers are all starting to feel the pressure. Many are rushing to bring in goods, as I mentioned, everything from apparel to auto parts before the strike hits. This rush pushed U.S. imports to multi-year highs in July and August. Multi-year highs. And because of that, shipping prices have spiked as well. Now, for some companies, this is leading to extreme measures. DSW, parent company of designer brands, has shifted half of its imports from the East Coast to the West Coast, even paid 10 times the normal shipping costs to fly in goods from Brazil. Yet the company still has thousands of units stuck in transit, which raises concerns about meeting delivery deadlines, not for just this company, but for a lot of companies that rely on imports. And so the threat is real. And not only is the threat real, the potential impact is massive. Ports on the East Coast and Gulf Coast handle billions of dollars in goods each day, including critical items like perishable food, medical supplies. If the strike goes forward, shipping rates are expected to soar once again. And in the end, who pays the brunt of higher costs? Well, consumers. And what does that look like? Well, inflation. So as we edge closer to this deadline, all eyes are on how businesses and supply chains will adapt. Did we learn lessons coming out of the pandemic? Are they stronger now than they were before? I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads, which you can get at iTunes, Google Play, and Spotify. Please be sure to rate and review us on any of those platforms while you're over there. And also tell your friends about our upcoming wealth webinar on October 8th. It will focus on effective strategies for managing your 401k and enhancing your retirement savings. Head over to investtalk.com. It is a free webinar, but you still must sign up. Independent thinking, shared success. This is InvestTalk. Good night.